Hello, everyone, and welcome back to Heart with Prisca. I'm so glad you're here. In this episode, we're going to dive deep into a critical topic for any aspiring entrepreneur: how to analyze a business before you buy it. If you've been following this series, we've talked about why buying an existing business can sometimes be a better option than starting one from scratch. We've also discussed where to find these businesses for sale. Now, you found a business that looks interesting, but the question becomes, how do you know if it's actually a good business? Just because a business is for sale doesn't mean it's worth buying. Just because the owner says it's profitable doesn't mean it is. And just because you're excited doesn't mean you should make an offer. One lesson I've learned on my own journey is this: a successful business buyer asks questions before making decisions. Today, I want to walk you through 10 things I believe every buyer should analyze before purchasing a business. These are lessons I'm learning myself as I evaluate opportunities across different industries. Let's get started. Number 1, understand why the business is being sold. This should be one of your first questions. Why is the owner selling? Are they retiring, moving to another province, changing careers, or experiencing health challenges? Or, most importantly, is the business losing money? Retirement is very different from declining sales. The answer provides valuable context for your entire negotiation. Don't be afraid to ask follow-up questions until you truly understand the motivation. Once you have that context, it's time to dive into the data. Number 2, analyze the financial statements. I like to say that numbers tell stories, and you need to read the whole book. Ask for at least 3 years of financial statements. Review the profit and loss statements, the balance sheet, and the cash flow statement. Look for trends. Is revenue increasing? Are expenses rising faster than sales? Consistency is usually more valuable than one exceptional outlier year. If you don't understand these, work with an accountant. That investment in professional help could save you thousands. Moving on to number 3, follow the cash flow. This is distinct from just looking at revenue. Revenue sounds exciting, but cash flow is what actually pays the bills and keeps the lights on. A business can generate $1 million in sales and still struggle if cash isn't coming in consistently. How much cash does the business generate each month? Are customers paying on time? Does the business experience seasonal highs and lows? You need to know if the cash flow can comfortably cover loan payments, salaries, rent, and taxes. Cash flow is one of the strongest indicators of overall business health. Number 4, understand the customers. Without customers, there is no business. You need to know exactly who is buying the product or service and why they keep coming back. Ask yourself, how long have they been buying? Do a few customers generate most of the revenue, or is the customer base well diversified? Businesses that depend heavily on 1 or 2 major clients carry significantly more risk. If one customer leaves, a huge portion of your revenue could disappear overnight. A broad base is much stronger. Number 5, evaluate owner dependence. This is a lesson that has really stood out to me during my own journey. You have to ask, can the business operate without the owner, or does everything depend on their personal presence and relationships? If customers only work with the business because of the owner's personal relationships, you'll need a very strong transition plan. Who answers customer calls? Who prepares quotations? Who manages employees? The more the business depends on documented systems instead of one individual, the stronger and more valuable the business becomes. Number 6, review the employees. People build businesses. You aren't just buying assets, you are stepping into a team environment. Take the time to understand the team, their culture, and their loyalty to the company. How many employees are there, and how long have they worked there? Are there key employees the business simply cannot afford to lose? What happens if they resign after the sale? A motivated and experienced team can make your ownership transition much easier, while constant staff turnover might require more attention than you expected. Number 7, examine the assets. You need to know exactly what you are buying for the price you're paying. Is the physical infrastructure of the business sound, or are you walking into a series of expensive maintenance problems? Are you buying vehicles, specialized equipment, or significant inventory? Make sure those assets are in good condition. Ask when major equipment was last replaced. Will you need expensive repairs soon? Sometimes a business appears profitable until you realize you'll need hundreds of thousands of dollars in equipment upgrades immediately. Number 8. Identify hidden liabilities. Not everything appears on the surface, and what you don't know can absolutely hurt you. You are buying the history of the company, not just its future potential. Ask about outstanding loans, equipment leases, and any pending lawsuits. Are there unresolved tax obligations or environmental concerns? What about supplier disputes or warranty claims? Buying a business means understanding the obligations that come with it. Due diligence is about uncovering surprises before they become your responsibility. Number 9. Look for growth opportunities. While you analyze the current state, you must also look forward. I always ask myself one important question. How could this business become even better under my leadership? Could new technology improve efficiency? Could a better marketing strategy attract more customers? Are there new services that could increase revenue? Or could the business expand into another city? You're not simply buying today's business. You're investing in tomorrow's possibilities and the return they will generate. Number 10. Run the numbers like an investor. This is probably my favorite lesson and the one that requires the most discipline. You must learn to remove emotion from the equation and focus purely on the facts. Calculate your actual return on investment and estimate your loan payments. Factor in a buffer for unexpected expenses and stress test your assumptions. What happens if revenue drops by 10%? What if interest rates increase or a major customer leaves? Good investors prepare for difficult situations before they happen. Optimism is important, but preparation is essential. Buying a business isn't about finding a perfect opportunity, it's about finding the right opportunity. Every business has strengths and weaknesses. Your job isn't to eliminate risk, it's to understand it. The better your analysis, the better your decisions. The better your decisions, the greater your chances of building long-term wealth. I'll keep sharing everything I'm learning as I continue this journey. If this helped you, please subscribe and share it. Until next time, keep growing in wisdom, purpose, and prosperity. This is Prisca, and I'll see you heart to heart.